Cashing out an IRA at Charles Schwab involves understanding IRS rules and Schwab's procedures. While IRAs are for long-term retirement savings, withdrawals are allowed but come with potential tax implications and penalties. This video explains the process, taxes, and common issues related to IRA cash-outs at Charles Schwab as of December 2025. Charles Schwab offers both traditional and Roth IRAs through their platform, with specific processes for withdrawals. For example, consider an IRA balance of $100,000. Withdrawing $50,000 from a traditional IRA would typically include 10% federal tax withholding. The withdrawal process uses forms like this IRA Withdrawal Authorization Form to handle the details. Key considerations include following IRS rules, understanding taxes on withdrawals, penalties for early access, and current regulations as of December 2025. There are two main types of IRAs, traditional and Roth. Traditional IRAs are funded with pre-tax dollars, and withdrawals are taxed as ordinary income. Roth IRAs use after-tax dollars, making qualified withdrawals tax-free. Early withdrawals before age 59.5 usually incur a 10% IRS penalty. Understanding which type you have and the tax implications is crucial before cashing out. First, log into your Schwab account using either the mobile app or the website. Next, go to the Accounts tab and select your IRA from the list of accounts. Then select Transfer or Withdraw, followed by Withdraw Funds from the menu options. Specify the amount you want to withdraw. For example, withdrawing $50,000 would reduce your balance accordingly. Select your preferred withdrawal method, direct deposit to a linked bank account, mailed check, or wire transfer. Finally, confirm any tax withholding. This is mandatory for traditional IRAs, where 10% federal tax is withheld by default. Schwab processes most withdrawals within 1 to 3 business days, with funds typically arriving in your account within 7 to 10 days. Withdrawals from traditional IRAs are taxed as ordinary income. For example, withdrawing $100,000 at a 25% tax rate would result in $25,000 in taxes owed. Roth IRA qualified withdrawals are completely tax-free. For instance, a $50,000 qualified withdrawal would owe no taxes. Early withdrawals from IRAs generally incur a 10% penalty in addition to taxes. For example, an early $100,000 withdrawal would add a $10,000 penalty. However, exceptions to the early withdrawal penalty apply, such as for disability or certain medical expenses. Be aware of potential state taxes, which vary by location. Some states conform to federal rules, while others add their own taxes. Over-withholding on withdrawals can result in tax refunds, while under-withholding can trigger additional IRS penalties. One common mistake is failing to account for all applicable taxes, both federal and state. Traditional IRA withdrawals are taxed as ordinary income, and state rates vary. Always calculate federal and state taxes before withdrawing to avoid underestimating your tax bill. Another mistake is neglecting to explore penalty waivers for early withdrawals. If you're under 59.5, a 10% penalty typically applies, but exceptions exist for qualified expenses like medical costs or first-time home purchases. Review waiver options before withdrawing. Ignoring required minimum distributions after age 73 can result in hefty penalties, up to 25% of the missed amount. Schwab now provides automated alerts to help you stay on track and avoid these errors. Recent trends show a growing preference for Roth IRAs, with Schwab reporting a 20% year-over-year increase in Roth conversions, driven by expectations of higher future tax rates and their tax-free growth potential. Digital tools are transforming withdrawals, with 60% of Schwab withdrawals now initiated through mobile apps, reflecting the shift to convenient online banking. Economic pressures from inflation and housing costs have driven a 25% rise in early withdrawals from IRAs, despite potential penalties and taxes. Let's examine real-world examples of IRA cash-outs through Charles Schwab to illustrate key concepts and outcomes. First, a 55-year-old client needs $100,000 for unexpected medical expenses. They use the 72T rule for substantially equal periodic payments, avoiding the 10% early withdrawal penalty. Second, a 60-year-old converts $50,000 from traditional to Roth IRA, paying upfront taxes. They then withdraw the same amount tax-free for a grandchild's education. Finally, an 82-year-old forgets required minimum distributions, incurring a $25,000 penalty. Schwab's automated alerts can help avoid such issues.